okay? No further input would be allowed with a stop-loss order. But if you have a put option, okay, you can bide your time and wait out a correction like this. There's no obligation to exercise. You're not obligated. You don't have to. When you own the contract, okay, you have the options. Okay, you may or may not wish to exercise it, but your exit price is absolutely guaranteed. Now, my mission is to give more investors control like this. The institutions do it. You know, if you ever look at a mutual fund prospectus, it will inform you that the fund manager will at times enter into married put positions or collars, okay, which is simply a married put with the call sold against. They do it all the time. And my thinking is, if this is available and used by these men and women that are responsible for stewarding millions, sometimes billions of dollars of the public's money, shouldn't we know how? Especially since we can do it more efficiently and better. Well, the married put is the only instrument that will allow you all the benefits of owning stock. For example, you probably can't play certain things that you might want to do with options in an IRA account, okay? But you can own stock and also own a put in that same account, and it'll protect you from loss. Can you collect dividends? Yes, okay? Does the fact that you own the stock, does it buoy the stock's price? Yes, okay? This is so much better than simply buying a long call. And buying a long call makes you tend to overtrade, doesn't it? Like we saw earlier, my friend with the Boston Scientific shares.
Mm-hmm.
Okay, the married put option is the only instrument that takes a real ownership of a stock and also guarantees it. And I believe that the only real holy grail of trading is risk management. Okay, and so what we like to say is, rather than picking stocks, pick stops. Pick the place at which you can get out with only just a small loss. Okay, and guarantee it with a put option rather than setting up a stop order, okay? And what makes Radioactive Trading unique is the idea of bulletproofing, using adjustments to our position, which I call income methods, because they do put money in your account like now. It's, I like to say, trade time. Okay, so I'm going to ask folks on the line what our level of sophistication is here on options trading. Because we're going to go through two other income methods. We're going to show you income methods 1, 6, and 3. And if we have a lot of spread traders on the line, for example, that's going to be really good.
And spread trades, you know, the credit spreads, that's one of those ones where you can, you know, work it, where you can be right 90% of the time and still get out with a loss every month.
That's right. That's right, because of the leverage. You can be right most of the time, and then the one time that you're wrong, the leverage takes you down. It wipes out all of your gains.
Yeah.
Okay, cool. We've got a lot. We've got a lot of folks replying to this one, and I'm going to close it right there. Okay, and share the results. Can you see that screen there, Mike?
Yes, sir. I can.
Okay, good. Looks like everybody's got a working knowledge of options. That's great, okay, because we can kind of move quickly here. 55% are doing covered calls. The same percentage is doing long calls and puts, and very many folks are doing spread trades. That's marvelous. I wonder why. Let's take a look at this, and I just want to explain something here. Not a lot of folks understand about synthetic positions, okay? But synthetic positions mean that they have the same risk picture. Okay. Now, certainly, a married put has the same risk picture as a covered call. I'm sorry, as a long call, right?
Mm-hmm.
And that's been pointed out to me, and I agree. The risk picture is the same. Money management is not built in, but the risk picture is the same. But look at this. We've got 55% doing covered calls trading, and only 9% would touch a naked put. Well, wait a minute. It's the exact same trade.
Mm-hmm.
Not a lot of folks realize that, but if you want to have the same risk picture as covered calls, go ahead and trade naked puts, okay? But if you didn't know that, you may be underinformed. You may not have been told this, and that kind of makes me angry. I want to really educate folks on what positions really mean, what they really represent risk-wise to your account. Okay. I'm going to hide the results here, and it's really good that we've got so many spread traders because a lot of the income methods are spread trades. But they're spread trades that are done as a response to what the market has already done, rather than trying to predict what it's going to do. Okay. Now, first of all, my unique setup on a married put is that we like to buy it very far out in time. Okay, 6 months, 5 to 6 months minimum, usually more, and we buy the put in the money. Okay, and I call that setup a radioactive profit machine. Okay, even though it's a married put. Okay, but it's a married put that's done very differently from most of the investing world. Okay, it's very truly an income producing asset, like Bob Kiyosaki talks about in Rich Dad Poor Dad. It's formed by buying a stock and then also buying insurance that stock's value won't go down below a predetermined point, and I like that point to be 5 to 8% risk. Okay, and then various strategies can be used to take money out without selling the stock. Here's a recent example. We got into Southwestern. I need to change this. We just had a really profitable one with Gilead Sciences. We're gonna update this, but right now I'm going to show this income method 6 trade with Southwestern. Okay, about 100 shares at $60.95 a share. At the same time, picked up a September 2008 $70 put option for $13. My total investment is $73.95, but I'm guaranteed to get at least 70 of that back. Okay, so my at-risk amount is the difference, right, Mike?
That's right. That's right.
The difference is $3.95 a share, or a total of 5.34%. Okay. Now, can you imagine setting a stop order at 5%?
No, I can't.
I mean, what would happen?
I'd get stopped out in 20 minutes.
Yeah, you get stopped out. The market maker would say, "Oh, looky, cheap. Let me take that," and he'd buy it from you, and then he'd go and sell it to someone else for more, and you'd be left there with, well, there's a expression that I use, but I probably shouldn't over the internet. But you'd be holding the bag, okay? All right. Well, here's the deal. About 2 weeks later, 15 days later, I sold to open an April $70 call for $3.90. Now, what's my risk picture look like now? I've got $3.95 was at risk, and I just took in the income by selling a call at $3.90. Okay, so what's my new risk picture there, Mike?
You've got only 5 cents at risk here. Yeah, as you say here, you're just about bulletproof.
Right. Now, I had somebody point out to me right after I made this trade, they actually wrote in, because they didn't have a real understanding of certain principles, okay? They wrote in and they said, now, wait a minute, okay? You spent $73.95, right? You spent, here, let me go back one screen. You spent $73.95 to put this thing together. Now, you just took in $3.90 by selling that call, and if you get exercised, if that stock stays above 70, then you're going to get the $70 for the call plus the $3.90 equals $73.90. You're going to lose a nickel. Well, what do you say to that argument?
Well, I still have several months left on my put
several
option.
Months left. Oh, yeah. See, this $70 put option that goes all the way out to September 2008, it's not going to be worth $13, but it's going to probably be worth something, okay? So I am pretty much bulletproof here. There's really no way that this trade can lose. Okay, but I will show you a new development. What happened was Southwestern had one of those one-day upsets. It had one of those things where the stock had some bad news or something, and a whole bunch of folks sold off their shares, and so it bumped down. And this call option that I had sold for $3.90 was suddenly worth $1 on the bid. Okay, I'm sorry, on the ask. And so I bought it back. I bought it back for $1. Now, if I had a nickel at risk, okay, and I put another $1 into the trade, what's my new risk?
We're back to $1.05.
Yeah, $1.05 a share. And the thing is, out of the entire invested amount of $73.95, okay, that represents a percent risk of about 1.42%, okay? So it wasn't bulletproof anymore, but I did have a 1.42% risk. And guess what? If 5.34 was okay, 1.42 is even better. I'm still bullish on Southwestern. Well, guess what happens? The next day, the very next day, the stock goes up again, and you spread traders are going to recognize this, okay? Let me see if I can do a little ballpoint pen thing here.